All right, so my name's Tom Robinson, and just to tell you a little bit about me, I'm from that state that no one likes to talk about. I'm sure a lot of you are from there as well, but I was born in California. Sorry?
Wisconsin?
No, nope, not Wisconsin. So I was born in California. I worked for a tax firm for 17 years in California. I started as an intern when I was 17. And it's not something that somebody comes out and is like, yeah, let's go do taxes. That sounds super fun, you know, let's make a career out of it. But I realized very quickly that I kind of had a knack for doing it. I had a knack with meeting with people, and starting so young, you have to really sell yourself, and you have to be better than somebody else who's a little older, a little bit more the norm, the type fit, the suit, everything else. So it's one of those things that I adapted, and I ended up being manager of the firm that I was at by the time I was about 21. Have people about twice my age working for me, ended up with about 8 or 9 employees underneath me, and just kind of built from there. So as far as moving up here, my wife's family's from up here. They owned property in Twin Lakes, and then they sold that, lived off the money, and moved to Athol. We've vacationed out here about 15 times in the last 20 years and decided California sucks. We don't like most of it. So let's go ahead and find a better spot for our family. Let's move to Hayden. Well, when we made that choice, COVID happened. Now we had locked in California, couldn't come right when we thought. So we ended up opening June of 2020. And we ended up winning Best New Business at Hayden by the end of the year. So our firm's only been open for about 2 years. Again, we just got nominated for Best of Idaho, Best of North Idaho, and we're growing pretty rapidly. And a lot of that is due to the local communities we have here, and you know, that kind of stuff, and groups like this. So that's a little bit about us. These are my wife and kids. This is kind of what I do everything for, is my family. I love them to death. I have 3 little girls and a little boy. I wanted 2 kids, and so my wife and I, we settled on 4. That's how that works. So my family is awesome. The 3 little girls are super smart. If you've ever had a little boy, he's all that. You strip his clothes off, butt naked, boots with an axe, you know, typical little boy stuff. So that's a little bit about myself. And let's start out with the quote. This is one of my favorite quotes about taxes. It says, "Man, do we really have to listen to a presentation on taxes?" That quote is by me. So I'm with you guys. If you're bored out of your mind and you don't want to be here, I understand what you're talking about. Taxes, not very exciting. Okay, so just some fun, interesting facts, kind of just break the ice and learn a little bit about stuff. In 1987, 7 million children disappeared. And the reason why is the IRS started requiring social security numbers on tax returns. So all of those kids that were fraudulently on tax returns all disappeared overnight. 7 million kids. The word tax comes from the Latin word taxo, meaning to estimate. So next time you're audited, make sure you tell your auditor, I was just using the Latin word, I was just estimating on my taxes. It'll get you guys out every time. Not really. This one just seems to make sense. Cowboy boots are exempt from sales tax in the state of Texas. Yeah. Just seems to go. Okay, just a couple quick other things. The tax rates at the Boston Tea Party were about 8.3%. Our lowest tax bracket's 10%. So it tells you a little bit about where they were coming from to where we are today. The current tax code is 16,000, almost 700 pages. And that does not include letter rulings or court cases, which means anytime a new law is passed in the tax code, the IRS is going to do a letter ruling basically to explain it. So 17,000 pages. That's my job to try and go through that for you guys. According to the Tax Policy Center think tank, about 42.5 filers will have no income or negative income by 2021, just due to COVID, due to different rules, due to rollovers from previous years. About 42.5% not paying any tax. A little bit more comedy. You have Aladdin and he says, or the genie says, "Whoa, bummer dude, next time you ask for wealth beyond your wildest dreams, better make it tax-free." Okay, so one of the things I like to do is tax strategies and tax planning, and this kind of illustrates the differences in how having a tax strategy can kind of help you. I know some of you can't see it, so I'll kind of go through. But basically you have woman 1 and woman 2, and the cases are exactly the same except for how it was done. So in woman 1's case, she basically wanted to make her daughter's life easier, so she added her to the house ahead of time. She went to the title company, added her on title, and woman 2 left the house as a sole beneficiary through a trust. And what we're going to see through this illustration is how that affects them down the road as far as taxes go. Woman 1 bought the house for $100,000. Woman 2 bought the house for $100,000. The house at the date of death was $800,000. So in both cases, the woman bought the house for $100,000, ended up passing away, and it was $800,000 at the date of death. Daughter 1 and daughter 2 have the same income, about $125,000 each. Daughter 1 only is going to inherit 50% of the house because her mom already added her to the title without selling it or doing anything else. Daughter 2 inherits the entire house through the trust. The difference is daughter 1 has a basis of 0 on her half and gets a step-up a basis of date of death on the mother's half. Daughter 2 gets a step-up a basis of the entire thing. And this is where it really pays to know. Daughter 1 is in the 22% bracket. Daughter 2 is in the 22% bracket. With the step-up in basis, daughter 1 pays about $175,000 in tax, where daughter 2 doesn't pay a dime. Huge difference, huge implications on just doing some strategies. All right, what is the difference between a taxidermist and a tax collector? A taxidermist will only take your skin. So when I do taxes, I get a lot of different people that come in. I know you guys can't really see that from some of your spots, but let me just tell you a little bit about what I see and what is done wrong constantly when it comes to real estate. So you have the rental versus business. We have long-term versus short-term. And this is where it comes into play, pretty big deal. A lot of times people will have the vacation rentals and the short-term rentals, and they'll claim it on a Schedule E on their tax return. The IRS has made it very clear that that's not the way to do it. So if it's greater than 7 days and provides no service, or 30 days, it is a long-term rental and it's passive income. Whereas if it's less than 30 days or it has significant services where they're coming in, making the rooms, doing that kind of stuff, acting like a hotel, then it's a business. Why is this important? When it's a rental, it's not subject to self-employment tax. When it is a rental, it is subject to when it's a short-term rental, it is subject to self-employment tax, which means you get an additional 15% tax on the vacation rental compared to the long-term. So make sure there is some stuff. Again, I don't want to get into a whole lot, but there is a lot in depth in this, and make sure you're seeking some help when it comes to which property you have. All right, difference between short-term and long-term investment properties. So short-term real estate, you're going to consider that wholesaling, rehabbing, flipping, anything under a year. When it's long-term, it's buy and hold, it's anything over 1 year and 1 day. And this is going to play huge parts in different taxes as well. So we'll get into that a little bit. All right, so short-term capital gains rate is taxed at ordinary income. So if you're in the 22% bracket, you're paying 22% on the investment for a short term. If you're in the 24% bracket, 24%, and so on and so forth. Long-term capital gains, I know this is extra tiny, but long-term capital gains rates, the way it used to be before the Tax Cuts and Jobs Act, was 10% less than your income bracket. So if you're in the 22% bracket, you're roughly paying 12% on those long-term capital gains. The way it is now is it's broken up into sections. You're either paying 0, 15, or 20%, and that's based on income level. So you can see if you're in the 24% bracket and you can drop down to a 15% rate on the long term, it's better if you have a couple days to drag out that escrow a little bit and fit into that category. All right, types of income. We have active and passive income, and this is going to play very important roles in determining what kind of LLC or what kind of entity that you want. So in an active, it's subject to self-employment tax, which is 15%, Social Security and Medicare tax on top of your normal tax. Again, I talked about that a little bit earlier, but how that works, what self-employment tax is when you are a W-2 employee, you pay your federal and your state income tax, and you also pay Social Security and Medicare. What that comes out to is about 7.5%, but what you don't see is your employer also pays 7.5% for a total of about 15.1% when it comes down to it. When you're self-employed, you have to pay both halves of the Social Security. That's what makes self-employment tax. You do get a credit for it. So for all you math nerds, it comes out to about 14.1% if you were really wanting to know. But that's on top of your regular tax. So again, knowing what type of income you have, it goes a long way into the type of structure. Passive income, no self-employment tax, but you can do a 1031 exchange, you can do depreciation, and you can do installment sales.
So Tom, can you take depreciation even though the value of the home is appreciated?
Yes. Yep, absolutely. Okay, so picking an entity type. There's 3 major factors when you're picking an entity on what you want and how that's going to factor into your decision on what you want to do. The first one is the state, the second one is third parties, and the third one is the Internal Revenue Service. So the first one is the state, and what you're doing is you're paying the state that you live in for a service, for protection. You're actually paying to get that liability. The states all have different rates. California is $800. The state of Washington is $200. Nevada is $600. New York is $1,200. The great state of Idaho is $20 for that protection for the LLC. So what you have is what's called inside liability. So when you're setting up an LLC, whatever you put into that LLC, you have inside liability on it. And what I like to visualize is a bowl. Whatever you put inside that bowl gets that liability protection. What I see a lot of times, people will set up an LLC for their rental properties or for their businesses, but they forget to transfer title and put it in there. So they don't really have the liability protection that they thought they did when they set it up. The next thing is third parties. You have judges, lenders, bankers, shareholders, and operating agreements. So operating agreements is a huge factor when you're thinking of LLCs. So having a good operating agreement will save basically the whole project that you have going on. It'll protect you from the other people. It'll help with the lenders. It'll help with everything that you have in there, and it's one of the main structures that you have here. Without a good operating agreement, your LLC will fail. Without the state paying the state fees, filing the statement of information, without paying this, the LLC will fail, and then the liability protection gets waived and it goes straight after you. So you have to have these two types in there. And the next type is the Internal Revenue Service. So you can pick which type of LLC you want. It can be, or what kind of tax it is. And that, I like to say it's kind of like a chameleon. You can be a disregarded, you can be a partnership, a corp, or an S corp. So where these come into play and how it factors is S corp and C corp do very good jobs for businesses and that active income. The disregarded and the partnership do really good for the passive income. Part of the reason why you do that is because, going back to that previous slide, you can still do the installment and sales, you can still do the 1031 exchanges, you can still do some of that passive stuff that you couldn't necessarily if you're a corp. Outside liability can be done through a holding company or an asset plan. So I do recommend that if you have multiple LLCs or you have other stuff, that you do a holding company or an asset plan. Land trusts themselves, I know a lot of people will set up land trusts. Land trusts themselves offer no asset protection. You have to have an LLC or something else to offer that liability protection. A little bit more comedy. Tax versus Superman, dawn of the tax day. Kryptonite, no, this is the entire US tax code. All right, so get into depreciation a little bit. Depreciation is expensing an asset over a given number of years. Real property that has been depreciated is subject to depreciation recapture. And what that means is you take, let's say a house, and you do it over 27 and a half years, or you do a commercial property over 39 and a half years. And what that is you're depreciating the value of that house over time. And what happens is if you sell that, you have to pay 25% tax on the depreciation recapture. And this is important because it's allow or allowable. And this is where a lot of people make a ton of mistakes when it comes to taxes. They'll leave off the depreciation, they'll have a rental property, they don't put it on the tax return. And what happens is if they ever get audited or they sell that house, they're still subject to this 25% depreciation recapture tax, and they never took it. So make sure that when you are doing a property that you are taking that depreciation. Self-directed IRA, I think we talked about that a little bit in the last meeting. I was here last month, so I kind of wanted to touch base with you guys on that. So you can buy real estate in a self-directed IRA. I do strongly recommend that you seek a custodian that specializes in that. That's not your typical investment advisor. You have to see somebody who does that specifically. And remember, it works just the same as another retirement plan. All of the gains, you don't have to pay any capital gains on any of it. It grows tax-free in the retirement plan, but you do have to treat it like it. So you have to wait till you're 59 and a half to start withdrawing the money, and RMDs are still required at 72. So if that means selling off some of the assets or taking some of the distributions, you still have to do that. If you do not take your RMD at 72 for any investments, the tax rate is 50% of the money you should have taken out. So RMDs are super important to take. 1031 exchanges. A 1031 is a like kind exchange. That means you swap one investment property for another. So that means you're swapping land for an apartment building, you're swapping a trailer park for a farm, you're doing a apartment building for a single family or multiple single families, but it's one investment property to another investment property. Under the Tax Cuts and Jobs Act, they changed that to only allow real property. So the way it used to work is you used to do a painting to a painting, stamps to stamps, collectible to collectible. They changed that rule to make it real property for real property. And how it works is basically all of the growth that you have in that property, you roll it into the next property. So if you have a gain in it, instead of paying the tax at the sale, you actually roll that into your next investment property. All right, some rules when it comes to the 1031 exchange. Both properties have to be within the United States, and you cannot touch the money through, or the money has to go through an escrow or an exchange. You can't touch the money. So what I have a lot of times in my office, somebody will come in and be like, Tom, I just sold a house and I love to do a 1031 exchange. I say, great, where's the money at? Well, it's in my bank account, I just sold the house. Well, I unfortunately can't take that because you didn't come see me first, you went and did it on your own. So now you're gonna have to pay tax on that. So a couple things that are really important to keep in mind when doing the 1031 exchange. The first one is there's a 45-day rule, which means you must select a property through an intermediary within the first 45 days. You can select 3 properties, but you have to close on one of those properties within 180 days. If you wait longer than 180 days, even if it drops out or extends, you lose all of that tax-free growth and it gets wiped out. So a couple more things on 1031s. Boot is any cash left over in a 1031 exchange. So, hey, we just sold a house, we rolled it over, we have a little bit of $50,000, we're gonna go on a vacation or we're gonna remodel our own personal house. Anytime there's any money left over in a deal, that is subject to long-term capital gains tax, and it is subject to that special depreciation recapture. Estate planning. So we talked about this a little bit in those 2 examples that I gave you. So if we do a 1031 exchange, let's say we buy property A and we roll the benefits to property B, and then we decide later on we want to roll that to property C, and each one we're deferring the tax and the gains on that. If we end up passing away and leaving that to the kids or to a church or to someone else, then they get a step up in basis and all of that capital gains is wiped out. They don't have to pay a single dollar on that. So there's some pretty good strategies when you think about it to roll into better and better properties, to make more and more, and then to leave it to the kids and not have to pay any tax on that. Reverse 1031 exchange, the 45-day and the 180-day rules still apply. The way this works, again, have to see a specialist because not all title companies do this or escrow companies, but you basically buy the property first and then sell yours and then roll it back into it. All right, some 1031 exchange pitfalls. Depreciation continues as just if you still owned it. So that depreciation recapture that we talked about, that number stays with you and it rolls to property and it still carries forward. Second home to second home does not count. A lot of people try and sneak this in there and the IRS is really cracking down on that.
Go back to that reverse 1031 exchange. Did you say that you can buy first, then you're subject to the timeline, so you have 45 days to sell?
Yes. No, you have 180 days. You have 45 days to select the property that you're going to sell, basically. So it just works in reverse. But again, finding a title company that does the reverse 1031 exchange is a little bit trickier to get that out of there. But yes, sir. Absolutely. So going back to the second home, this is very key. It's investment property to investment property. So if you're selling a vacation home or home that you go to all the time or you live in it a little bit, this does not count and you're subject to the long-term or short-term capital gains rate still. LLCs can do a 1031 exchange, but there's some stuff within that. You have to get everything in writing. When you're an LLC or a partnership, you have different people, different things going on, so get everything in writing. Buy-sell agreement, make sure that you have your ducks in a row with the partners, and if they're gonna end up leaving or end up, what if there's a divorce, what if there's something else, make sure that you have that stuff in place in case there's problems and in case there's stuff. There's swap and drop. If you're gonna do this, seek an attorney, seek professionals, but basically what that is one partner doesn't want to be a part of the 1031 exchange and they relinquish their shares in that company. Again, seek an attorney, seek professionals that can help you with that. And not all entities can do 1031 exchange. So if you're in a corporation or something like that, the 1031 exchange rules do not apply. So make sure you pick the right entity for what you want to do.
Tom, let's say that somebody has a home that they rent out for more than 30 days, but the tenants leave, they buy a house, whatever, and then they use it for the rest of that year for a second home, so now you've got a little bit of both going on in there. But then they sell it at the end of the year, December 31st.
So again, that falls under the rules right here. If they're using it for their main home or they're using it for personal use, you can't do it. It has to strictly be an investment property.
For how long? Like if it was, but then for years it's a long-term rental?
So yeah, if it's your main house and then you end up converting it, so I would say, I don't know if there's, to be honest with you, a specified time, but it's more of the intent of the use. You know, what are you doing with it? Are you doing it just to roll over capital gains? Are you doing it to actually become an investment property, to make it a rental? You want to do it? That's really what they're looking for, is to make sure that it is an investment property. You are doing it to be a rental. You are doing it to do that. And now you've found something else. So if you're just trying to do it to skirt tax, that's where you'll get into some problems. So,
Tom, quick question on 1031 exchange. In obviously lending, you have 4 units or below, 5 units or above, 4 units or below residential, considered commercial. Does it matter in a 1031 exchange? So somebody can go from a duplex to a 10-unit apartment?
yes, sir. Yes, sir. Or you could do the opposite, where you go from a 10-unit apartment into 5 single-family rental properties. You can do that. Again, real property to real property. One thing, I don't think I covered it, I might have missed it. There's this secret rule, tax rule, and that's the intent. So what that means is if you're trying to do a 1031 exchange for your main house, and what I mean by that is, okay, we have an investment property, we're rolling over the capital gains into another investment property, but now we're gonna get kind of tricky and we're gonna move into that property. Well, the IRS really frowns on that because that's not really what this is for. If you do that, you will get in trouble, you will have problems. What it is intended for is investment property to investment property. So like I said, you can do that, but it's very rare circumstances. It would have to be, all right, there's a market crash, there's something going on, and all of a sudden I can't do anything but move into that property. Again, you might want to seek an attorney to sit down and talk about all that before you move into that property and try and move into a 1031 exchanged house. I don't recommend it, but again, seek professional help on that. Real estate investing credits. So the first one is the rehabilitation credit, and that goes for historical structures and structures pre-1936. And you get a 10% for pre-1936, a 20% credit if it's a historical property, and if it is, that increases if it's in a disaster zone. So Hurricane Katrina, a historic house gets destroyed, now it's being rehabbed. They can get a 26% credit for the cost of that thing because it's stepped up for the disaster. There's a low income housing credit. This is a dollar for dollar tax liability credit. It covers 10 years after low income property is placed in service. The property must receive an allocation from the state housing authority. So again, if this is something you're interested in, like Sarah said, you want to do all of your research ahead of time. Does it meet the state housing agency's stuff that will show up right in the escrow when you do the stuff? You can do the research and find out which of these properties are. You can even get statistics on which of these properties are listed and everything else. And then each state caps that number. So again, it's a dollar for dollar credit for all the money you put into that house, but it's capped at a certain dollar amount per the state that you live in. Lastly, there's a resident energy credit. This is like for solar or asphalt roofs, and what this is for, it's pretty awesome. So you get a credit for 27% of the cost of it. So how that works is you actually take the credit right against your tax liability. So if you have $6,000 in tax liability, you qualify for $10,000 of the credit. It wipes out your tax and you roll over the rest of it to the next year when you have more tax liability. So this can be a very good credit if you qualify for it.
Quick question about that. Is that for properties that you resell or hold on to?
That's ones that you live in yourself.
Oh, I mean, before that,
the low income housing and
the old properties. The historic.
Yep. So that one I think is for all. You don't have to live in those ones. It's for any building on that.
Do you have to resell the properties, or if you're just keeping them as rentals?
That I don't. Honestly, that I don't know. I think you can do it for rentals, but I'd have to look and find out for you, man. Albert Einstein said the hardest thing in the world to understand is income tax. All right, discount points. Discount points is similar to prepaying mortgage interest. So how that works is discount points are usually paid one time up front when the mortgage is first arranged during when it's arranged or during refinance. Typically, 1 point costs 1% of the overall mortgage. So a $250,000 mortgage would cost you $2,500 for that one discount point. So how that would help you out is that might drop your interest rate from 3.375 to 3.25. How this helps you is if you're owning the property long term, because the longer you own it, the better this credit will be for you, and I'll show you in the next slide. So how you factor it is cost of discount points divided by monthly interest savings equals the number of months until you break even. So in that last case, $2,500 for the one discount point is $35 a month in savings, so it's 72 months before you break even. So anything after that, you're actually saving money by buying the discount points. Does paying discount points make sense? How much can you afford up front? How long is the property going to be held? And does it make sense to put a bigger down payment to shrink mortgage insurance? So if you're looking at discount points versus how much money down, if by increasing the money down you can get out of PMI or the mortgage insurance premium, sorry, I said that wrong, but if you can get out of paying that, then it's worth dumping the money into the down payment of the house instead of doing discount points. The IRS considers discount points prepaid mortgage interest, meaning you can deduct them over the life of the loan. There is some special circumstances where you could take them up front. I have this awesome thing, if anyone wants it. It's the IRS tax topics. So if you're bored at night like me and you want to read tax topics or, you know, something like that, some court cases, you can talk about those very specific items on how to do that.
Does this show up, like the rates that you pay, will it show up on your tax mortgage statement?
So it'll show up on the HUD-1, and it should show up on that very initial escrow 1098 form as well.
Like report it separately?
Nope, it'll show up right on the forms. And then one thing to keep in mind, this is, a lot of people mess this up, discount points is not loan origination fees. Those are completely different. So make sure you know what those are and what you're doing. And then the last slide.
Real quick.
Yeah.
Likewise, in a lot of scenarios where you said 3.375, $2,500 in your example, saves you $35 a month. Likewise, you can go above market rate. You can go with 3.5, 3.625, 3.75. The higher you go above the market rate based on your profile, you can get closing cost credit. So that's money you don't have to pay to bring into the close of escrow. So if you're planning on having that loan for a somewhat short period of time because you're going to sell it, take the higher interest rate so you get credit that you don't have to bring in money to close, and then you're going to pay that off anyways, and that's another way as a strategy to manage your cash flow.
Again, seek expert help. That's exactly why.
A lot of people don't know that you can pay an above market rate and actually get credit back. So if your closing costs are $10,000, in your example, you're only bringing in $7,500 or whatever you're in the bonus.
Yeah, pretty awesome. And then the last slide on here is the GAO, the Government Accountability Office. I'll just read the bullet points, but 49 to 54% of all active corporations had negative taxable income. And then the ones that did have positive income were completely offset by carry forward losses from previous years, and that was about 15 to 19% of those that wiped out their taxes. That's why a few years ago you heard the story of Bank of America made about $4.4 billion and paid no money in taxes. That's why. So that's it, guys. Thank you for listening to boring tax stuff. Thank you.